Good afternoon, everybody, and welcome to the Fintech Nexus weekly news show. Yes, we are no longer Lender Fintech. If you missed it, we rebranded just a couple of weeks ago. And of course, we are coming right off our huge event. Oh, by the way, my name is Peter Renton, Chairman and co-founder of Fintech Nexus, joined today by Kevin Travers. How are you doing, Kevin?
Great. It's a rainy day, but it's great to broadcast from New York City.
All right. And we are just fresh off. There's just two of us today because we've got basically half the Lender team out right now, half the Fintech Nexus team out because we had our huge event last week. It was a roaring success, really much even better than our expectations. It was just a fantastic show, and we're all recovering. And so what are your initial thoughts? Let's just talk about the show just for a second before we get into the news, Kevin.
It went fantastic. I had the pleasure of covering the consumer credit and Web3 crypto tracks. And so I haven't seen that many people in one place since the Yankees game that I first went to after COVID sort of ended. It was amazing to see everyone out and about and excited for what our new Fintech Nexus brand is ready to cover.
Yep, we had just over, it was almost 4,200 people were registered to attend, and it was a packed house. Very many of the sessions were completely packed, and it was a lot of fun. The energy was high. People were in good spirits. But anyway, let's get into the news on this short week. We're going to lead off with Affirm and Stripe teaming up. Affirm seems to be partnering with everybody. They're getting more and more of these major partnerships. They've talked about, they've had Shopify and Fiserv before. Now Stripe. Stripe has millions of customers, and now with Affirm's adaptive checkout, which kind of is real time, sort of depending on what you're actually checking out, will offer you different options. It's Affirm. It's a way for them to kind of get their checkout mechanism in with huge numbers now of new people. So, what are your thoughts, Kevin?
It seems like it's going to be the trend for what seems to, well, Affirm is a hugely consumer-focused fintech, but it looks like the way this year is going now that it's basically halfway through is people are partnering and consolidating with business-to-business focused transaction, which is good for us because that's what we cover. But compared to consumer pricing, like their stock went down and they might not be doing so hot, but they definitely are partnering with everyone they can. They're sort of using this as an opportunity to build while they were sort of on their hot streak about a year ago in August, when they were making the news. But still now, we've gone through buy now, pay later a bunch in the newsroom, and we sort of thought the trend was over. But like we saw at USA and what we see online is all of our stories are always the most read if they mention buy now, pay later. So it's still hot, even if the prices don't seem so, right?
It is. It really is. I mean, it was one of the surprising things to me. Buy now, pay later was everywhere at our event last week. People were talking about it in the small business track, in the consumer lending track, obviously, and the credit and underwriting, and all over the place. We had people still talking about buy now, pay later. It is not a trend that seems to be slowing down, and in fact, I'd almost argue it's speeding up again. So. Okay. Anyway, another interesting story that caught my eye this week was we talked about this earlier today, Kevin, was the NFT marketplace OpenSea. This was a story, I think it was late last year, if I remember rightly. It might have been earlier this year, but anyway, talking about this guy who works at OpenSea. And he knew what NFTs were coming onto the platform, onto the homepage of their platform. So those NFTs are always more valuable. He would buy them in advance and then sell them for 2 to 5x his markup. I mean, 2 to 5x his purchase price. So, Matt Levine wrote about it today in Bloomberg, and he always has an interesting take. He actually wasn't all that, didn't think it was all that big a deal. I mean, it's fraud for sure, but he talks about everything as securities fraud. This is basically everything is wire fraud, and this is an example of wire fraud. And so it's just goes to show if you're the NFTs might be the Wild West, but the law of the land still applies.
Yeah, absolutely. I sort of see this as, well, he was arrested right here in New York. And I sort of see this as a signal from the more liberal enforcers in maybe California or New York State, or just generally with the Fed we have now, that even though it, like you said, it is the Wild West, there are still going to be, I think, more of people getting charged for insider trading, securities fraud, and like you said, wire fraud. I think it's been really unaddressed recently. I know that this case, I think the initial allegations came up in a Twitter thread where a user actually found his account or an anonymous account was making a ton of bank off of very lucky bets, but it turned out it was connected to his account allegedly.
Right.
And that's sort of where this came from. And if that's, I mean, if that's the place it's going, we love supporting like careful regulation, I guess, here at Fintech Nexus. But if that's the place it's going, we can only expect more of this. I don't know. What do you think?
Yeah, I mean, I think if you are gaining an advantage on inside information, that is not available to the general public, and you're, this is really insider trading, and I think the government wants to make an example of NFTs. I mean, they're not talking about huge sums of money here, but they're making going to make an example of this. He had his regular OpenSea account, which was public, and then he had a whole bunch of other anonymous ones, and that's where I said this Twitter. So someone investigated and found out. Oh, look at this person who's really lucky, buying all these ones before they go on the homepage. But yeah, I mean, he should be. I mean, assuming this is obviously everything is just allegations right now.
Yeah.
Until he's proven guilty, he is innocent. But if he is proven guilty, I think that will, I think it sets the tone that we're not going to allow kind of this sort of Wild West mentality in to continue. So
yeah.
Anyway, moving on, Binance Labs. So Binance, obviously one of the top exchanges on the planet. They have their own fund, and they have their own incubator, and now they've got a new fund, a huge new fund, $500 million. Who says it's a crypto winter? $500 million supported by, mind you, this might have been closed earlier this year, but DST Global, Briar Capital, other family offices, corporations, some big names that are investing in this fund, focusing on Web3 investments at pretty much all stages of development. And, there's still going to be money flowing into Web3, don't you think?
Yeah, absolutely. It's funny that when everyone is worried about crypto winter, all the public-facing companies, all the VCs sort of tend to wind down. But these crypto-based companies like Binance, it's when they start to grow the most. It's when they're sort of battening down the hatches and focusing on growth. And I mean, PitchBook, it's a great article. PitchBook was referenced in research that they found $2 billion was raised for 164 funding deals just in May alone in the crypto Web3 space. It's a space we're looking at more and more as a place of innovation. And it's sort of funny to compare it to other venture capital in tech and fintech that crypto has sort of mirrored in its valuations. It's gone up and down, but not going anywhere anytime soon, I guess.
Yeah, and of course we have the Andreessen Horowitz $4.5 billion crypto fund that the money has been raised. So I think new crypto companies are probably going to be able to raise money much more readily than the traditional fintech companies are, I think, and that this money has to be put to work. And like the Bankless guys say, they've been saying this for the last few weeks now. Build the dip is what they're talking about. So crypto prices tank, and the whole idea is you build new products, you develop new ideas when prices are down, and and that's kind of, I think there's so many good ideas there, and they even said they're earmarking money. I read in the article in TechCrunch that for sectors that don't exist yet. So they know there's going to be new things that come out in the next year or two, and they want to be part of it.
Absolutely, and so do we.
Yes, indeed. Plug for our Merge event in London happening in October, which is going to be completely focused on Web3, the Web3 intersection with banking. So anyway, let's move on because we have another crypto story. This is sort of somewhat related, but basically Ripple and FTX recently told CNBC they're on the lookout for deals. There are going to be those companies that they've raised money, they haven't quite hit the metrics they said they were going to hit. They're having trouble raising new money, and there's going to be some deals to be had, some M&A deals. FTX has already said they're looking to acquire a brokerage firm to really ramp up their stock trading offering. The Ripple CEO's Brad Gillinghouse, he was in Davos last week, didn't come to our events. Silly man, should have blown off Davos and come to Fintech Nexus. But anyway, he basically said that Ripple are in the hunt for M&A deals. So it's that there will be consolidation in crypto, it seems like, this year.
Absolutely. It's just like the partnership of Affirm and Stripe. It's just like consolidation in fintech being mirrored, but it's a little different only because these giant crypto exchanges they were flush with cash at one point, but when the user base dies down of people buying tokens and coins and what they sell on their platforms, they need to find sort of other value added. I think we're going to see FTX's SBF himself is going to be on stage in Austin, Texas next week. And I think we're going to to the Consensus event, trying to cover it as best we can. And I'm pretty sure he's going to lay down, or I'm hoping he's going to lay down his plan for opening up a brokerage or a really well-regulated like stock trading platform or something, to branch more than just a consumer crypto focused place and to go further, just like we're seeing in the rest of fintech.
Yep. We both have the good fortune to be heading to Austin next week, so where we'll hear that live. And the one thing I just want to add, that they said that there was $55 billion globally in M&A deals in crypto in 2021. That was up from $1 billion in 2020. 2020 was still in the middle of the crypto winter, and certainly the first 2/3 of the year, 3/4 of the year was like that. So who knows what we'll see this year in total M&A deals. Anyway, moving on. This is a piece that you wrote, Kevin. So we have NAV teaming up with Marcus to offer small business credit lines. Why don't you tell us a bit about the coverage you did?
Yeah, so it's great to see. My first job was writing in SMB funding, and it's great to see one of the known leaders, front runners in that space with their tech, coming to join and partner with Marcus by Goldman Sachs. They've really turned into like a neobanking digital brand giant, and now they're branching out with offering consumer, but also like business to business focused platforms and products on their. That's what they're doing. And it's cool to see. They're going to become the next super app maybe, but it's a competitive space in neobanking. And
it is interesting because Marcus has really been focusing on consumer for the most part. Now, Goldman Sachs has, got to, they have the Amazon program. It's business to business, small business lending there. So but it seems to me this is really the first time I think we've seen Marcus really talk about small business, and they have was on that famous slide from their Investor Day a couple of years ago where they said all the different areas that Marcus was going to get into, and it was still primarily consumer, but they're like anything, if they're going to be a super app, they probably want to have small business. Every there's so many small business owners in in the country, and a lot of them a lot of the very smallest of small businesses really are very similar to a consumer lending product. But NAV's as you say, it's a big name, an established name in the small business lending space, and it's going to be it's a great thing for NAV to get the Marcus deal. I'm sure they were looking at others in the space, but NAV was the one that got the deal, and we're interested to see whether this is really a driver of lending volume. That's going to be the interesting thing.
It'll be fantastic to see. I'm hoping to see Amazon, Google Pay, PayPal, others that do offer small business funding, but don't really announce it that much, to come out with a big announcement that they're like openly competing in the market like that, because they do, but we just don't hear about it as much. So it's cool to see, I guess, the first of more of the TradFi institutions with an open consumer business to business focused SMB offering.
Yep. Yeah. And it's interesting that they could probably do this themselves, but I think it makes sense. That's what Swati Bhatia from Goldman Sachs the head of the Marcus Consumer Bank is, she said on our keynote stage last week that they're very much focused on partnerships at Goldman Sachs, and this is another example of that. Anyway, moving along to the Winklevi, the Winklevoss Twins. They run a company called Gemini, and this is, they announced in a blog post, I think it was just posted this morning, they announced that they are cutting 10% of their workforce, citing the turbulent crypto market and also, the macroeconomic picture isn't that positive either. So they're being, this is the first of probably what will be many. I know actually not the first. There are others that have indicated they're laying off people, but Coinbase hasn't said they're laying off anybody, but they have said they're slowing down hiring. This is the crypto winter for exchanges like Gemini and Coinbase. The crypto winter is one thing, but it's just the lower trading volumes, less people buying. It's really, the revenue has just got to be so choppy in these platforms.
It's crazy to see how one company can announce, we have a new venture fund that's going to be investing, and another company could saying, we're laying people off. It's like Better.com borrowing their Zoom firing, but that's just one of many. Klarna said they're laying people off, Robinhood. A lot of people are sizing down by about 10%. In Gemini's case, it's only like 100 people out of their 1,000-person workforce. Robinhood, it was 700 people from their 7,000-person workforce. But I don't know. Compared to that, the Wall Street Journal said on Tuesday that apparently Fidelity Digital is going to double their hiring. They're going to bring on 100 people just to get institutional crypto or digital asset focused lending and products onto their own platform. What do you think about that? That's such
that was surprising to me because it seems to be bucking the trend. Obviously, there's Fidelity has, that they've gone all in on crypto. They're the ones that are doing the crypto 401k, and they've got obviously massive institutional business that I know that there's the demand to hold crypto. This is something that you see from banks and others that their customers want to have that as an option. Even though crypto is down, a lot of people now are viewing it as, this is a buying opportunity. And not only that, if I'm going, they missed out on the first wave of crypto, maybe now they can get in on this wave before it gets going. And I feel like there's demand. There's still a lot of demand for consumers who want to hold crypto and not necessarily trade it, but hold it just as an asset class, as a diversification from what they've been doing. And Fidelity seemed to, with their institutional arm, doubling the number of workers there. That's a hugely bullish sign, I think.
Absolutely.
Okay, moving along. This is one right up your alley. This is from the Financial Brand this week, Kevin. Why bank marketers are moving into TikTok. And Kevin, you are our resident TikTok expert here. And why don't you maybe, we had did you see that session we had last week on influencer marketing?
Yes, it was fantastic. And we actually invited a bunch of TikTokers or finfluencers to the event. They could take part in talking about the Fintech Nexus brand, but also they could walk around and meet people and take part in the networking. It was an electric event, really. They were talking about getting paid $7K just to promote in one video, in one 30-second video. They get paid by banks or brands to promote to millions of people. And that's different and cheaper for larger brands, but it's way different than normal ads or newsletters or ways we promote brands today. I don't know. What is your take on it? Because I'm on TikTok, though I try to stay off of it, unless trying to promote like the Fintech Nexus brand, honestly.
I am not on TikTok. Well, I have a TikTok. It's on my phone, but my son is on it a lot, and he mainly shows me soccer videos, and that's what he's really into. But there's TikTok. It can be whatever tickles your fancy. There's a TikTok. Seems like community that is creating videos. But yeah, I think. It's still early days, and what was fascinating to me, like the thing about TikTok, there's 1 billion users of TikTok, and they're primarily Gen Z and the younger millennials, and these are people who are banks finding it hard to reach. So, I mean, I was struck by, it wasn't a packed house. We had an influencer marketing session that was really focused around not just TikTok, but has had a TikTok influencer on there. And basically, this is just another, this is performance marketing. So, they had an agency on there as well that talked about, you're a bank, and a bank, a 200-year-old bank is using influencer marketing on TikTok to help drive younger people into their brand. And so, to me, I feel like this is early. I mean, it wasn't a packed house. There's only certain people that are interested in this. But I looked around when I was in the room, and people were engaged. People were really listening. Yeah. They weren't just checking on their phones. So, I think it's going to be big. I think that that there is a real opportunity. I mean, being early will get you a better deal. But the thing that was stressed out, this is not something that you just throw some money up and just hope for the best. A lot of these things are, these TikTokers will say, I promise you 100 new leads for your $7,000 spend or whatever it is, and this is sort of a way, these 100 new leads that they get, they may not have gotten any other way, or they might not have gotten with their traditional marketing programs. So it's not just, spend money and hope, it's performance marketing. So, right, I'll give you, throw $7,000 on it. If it doesn't generate 100 leads and they generate 5 leads, then you don't do it again. But these TikTokers are pretty confident in what they're offering.
It's amazing how precise the algorithm is at bringing people together. It is definitely a way to reach people, and it's an attention market that's scarce still. It's not like it would do better for consumer focused brands. And it's not like you can just say, here's an ad for this product, go buy it. It has to be within the dialect of TikTok, which is a challenge for most brands. It's a challenge for me, and I try to make them for Fintech Nexus. Right. But for that 20 to 30 market, for that hyper focused, I guess, finfluencer, there is a way to reach Gen Z and younger millennials, which may seem like they just like dancing and making music videos or whatever. But at the end of this decade, there will be 40 trillion in real earnings from the largest generation in human history. And that is something that every brand, every bank, every fintech should think about and be inspired by in a way to capture people that they haven't sought out before.
Yep. No, I think it's, and banks are not going to be all that early to it, but I mean, a lot of the fintechs are also using it. Current uses it, Step, the teen sort of banking app uses it. And I think, just if you're listening to this and you're a banker or a fintech and you think this is worthless, go ask a teenager or someone in their early 20s about it, because they will tell you otherwise. Anyway, moving on. This was I want to highlight Ron Shevlin's article. He provided some unsolicited advice for Chime, and we had the CEO of Chime as our opening keynote last week, and it was actually pretty interesting if you read the whole thing. He basically is saying that Chime is going to struggle because their average customer is less affluent than the average American. They have lower earnings, less assets, and Chime is trying to monetize these people, and they're doing it right now through their debit card, the interchange fees on debit cards. That's primarily how they're making money. But they'll eventually, I'm sure they'll get into lending at some point. But what Ron Shevlin is saying is no, they should become the Sam's Club for the digital economy and move beyond financial services. Now, we're seeing some of this in China. We're seeing it in Latin America as well. Haven't seen it much in this country as far as financial firms moving beyond financial services, but he was talking about the number one requested thing to wrap up in the Chime app was roadside assistance. So your AAA type, AAA road, bundle that in with Chime is what I think that's what a survey from Cornerstone Advisors said. Or cell phone insurance, which is kind of financial services, I guess, is another thing they could get into, and it's going to be interesting to see, because when you're a digital app, I mean, you can, a super app may end up being far more than a financial app. What do you think, Kevin?
Yeah, absolutely. I think by virtue of being a digital app, it's easier to offer services that you wouldn't ever think of offering at a digital or a non-digital bank branch. Mm-hmm. I think Chime has gotten fresh off the stage, and Brit is already getting questions about his rumors of an IPO. Like, there's an IPO rumored, and then it was rumored it wasn't going to happen anymore just this past March. And if you look at valuations of other now public fintechs and neobanks, maybe it's not a bad idea that they sort of avoided their IPO while they're looking for what their actual like long-term value is. If Cornerstone Advisors and Shevlin says that they're not going to make money off of their standard users, maybe the subscription model of banking that we're seeing more and more as a hot topic this week in these coming stories and in this one, maybe the subscription model of banking is something they can sort of hedge their bets on. And not just banking, but like you said, super app or insurance or customer service, I don't know, identity protection.
Yeah, I think, and I'm sure Chime is very happy they're not a public company right now, because their stock would be down dramatically from a year ago. But anyway, you teed it up, so let's talk about this subscription model. This is another article in Financial Brand, how a subscription model could replace banking's legacy fee structure. Because I think it's interesting because people I've always hated if you charge $10 for a checking account, $10 a month for a checking account, because it's just a checking account.
Yeah,
and it's free at a bunch of other places. I mean, people don't want that, but the subscription model, I feel like there's a the generation, your generation, Kevin, that is used to Netflix and Hulu and Amazon Prime and what have you, the subscription model where you're getting value. And I think that's the key is you see there's companies like Nubank in Latin America, but here, Acorns has a subscription model, Moneyline has one, Revolut has one, and they've all been relatively successful in generating revenue from subscriptions because they're providing value that that people want. People just if you're just offering a plain vanilla checking account, people are not going to be comfortable paying a subscription for that. But if you've got some bells and whistles on it, then they can, you can get money. You can get some monthly revenue in.
Absolutely. This article by the Financial Brand, it references research that the market for subscription banking will go to like 1.5 trillion by 2025. I believe that, but it is interesting as like an elder Zoomer or whatever I am, that I'm the generation that's supposed to be spending the most on subscriptions, and that's probably true. But so I'm looking at my subscriptions recently, actually, because PNC sent me a message and said, your free student banking account that's basically only debit that you use for direct deposit. Well, you're gonna have to pay $7 a month for that now if you want to keep using it. And I'm thinking, well, I use Fidelity for like my retirement. I use Venmo for payments, and I use other stuff to pay rent. Why would I use this? And at the same time, I pay $170 on subscriptions, including a $40 Wall Street Journal monthly. Now that's the expensive part. But comparing this to, say, Netflix, that led the whole world in showing its subscription model, recently tanked because their subscriptions are down and there's a bunch of competitors. Is that really the best standard to live up to for banking? Well, maybe, but it has to be, you're right, more than just the standard debit. Because I do not want to pay $7 a month when I could just use PayPal or Venmo or something to use deposits.
Yep, indeed. Okay, well, we're almost out of time. One last story I want to get to, and this was we've been hearing about this crypto legislation. Senator Lummis has she's a senator from Wyoming. She's been talking about this legislation that she's going to be releasing on June 7th. Well, the bloc obtained the 70-page text of this legislation. We don't know if it's final. It's probably not exactly final, but it's probably close. And basically saying that crypto regulation is going to fall primarily under the CFTC. Little bit of SEC thrown in. We've got a new term, ancillary assets.
Ancillary assets.
There's a new term that is going to be in this legislation, but it's we'll find out next week. We'll talk about it on this show next week because it's going to be important. This is going to be one of the most thoughtful pieces of legislation out there, and big parts of this could well become law because there is certainly some momentum for legislation.
Especially from such a crypto positive state like Wyoming, which is like Delaware, but even more friendly towards incorporation within their borders. I'm really excited to see. I think this is the year where we see federal law about what defines crypto and a lot of regulation coming down. And it's cool to see at least a 70-page document that's supporting a lot of innovation that's happening now.
Yeah, because I mean, the reality is this sort of period of uncertainty we're living in now is not serving anybody. It's not serving consumers. It's not serving certainly the platforms, the crypto companies themselves. So I think we certainly need some clarity here, and hopefully this will be the start of providing that. Anyway, we are out of time. Thank you very much for watching or listening. We'll be back same time next week. I'll be coming at you from the Consensus event in Austin, Texas. So until then, have a great weekend, everybody. Bye.
Yeah, have a great one.
See ya.